There is a particular kind of unease that does not announce itself. It does not arrive with a crisis or a headline. It shows up in smaller ways. A purchase gets delayed that would not have required a second thought a few years ago. A brand gets swapped at the store not out of preference, but out of habit now. A medical appointment gets pushed back a few more weeks. The bank balance gets checked more often than it probably needs to be. None of these are dramatic events. Taken individually, they barely register. But together they suggest something is shifting in how people relate to their own financial lives, even when the income is still coming in and the job is still there. This is not a story about people who are struggling in a conventional sense. It is a story about people who are managing, but who feel something tightening around the edges. The sense that there is less room than there used to be, less margin for error, less capacity to absorb what used to be absorbed without much thought. That feeling is worth examining carefully, because the official picture does not explain it. And the gap between what the data shows and what households quietly experience is exactly where this story begins. The Bureau of Labor Statistics currently places inflation around 2.4%. Unemployment sits near 4.4%. Average hourly earnings in the private sector have moved above $37. Total compensation has grown roughly 3% over the past year. These are not the numbers associated with a system under strain. They are the numbers of an economy that by most conventional measures is functioning reasonably well. And yet something does not quite add up. The disconnect is not about whether wages are rising or whether prices are falling. It is about the relationship between the two. It is about how much of that income actually remains after the fixed obligations of modern life are paid. And it is about whether that remaining portion is growing or quietly shrinking. The personal saving rate tracked by the Bureau of Economic Analysis has settled into a range of roughly 4 to 5%. That is not a dramatic low, but it is not a sign of accumulation either. It reflects a household economy where income is largely consumed by current obligations, but where the buffer between stability and disruption is thin and not noticeably thickening. What this means in practice is that income growth and financial relief are no longer the same thing. Wages can rise while the margin stays flat or narrows. That is the tension running beneath the surface of the current economic moment. Not collapse, not crisis, but a quiet erosion of flexibility that does not show up cleanly in the headline numbers. To understand how that erosion works, it helps to start where most household finances start, with the cost of having a place to live. The National Association of Realtors puts the median existing home price at roughly $398,000. Mortgage rates based on recent Freddie Mac data remain above 6%. Yet these figures are not extreme by long historical standards, but they represent a significant shift from the low-rate environment that shaped expectations for a large portion of potential buyers over the past decade. The practical effect is straightforward. At current rates applied to current prices, a monthly mortgage payment on a median-priced home absorbs a substantial share of household income, not just for buyers at the lower end of the market, for buyers across a wide middle range. The question for many households is not whether they can qualify for the loan. It is whether carrying that payment leaves enough room to function financially in everything else. For those who cannot or choose not to buy, the rental market offers a different but related set of constraints. Zillow estimates the national average rent at close to $1,895 per month. Growth has slowed compared to the sharp increases of previous years, but what matters more than the rate of change is the level. Rents rose significantly across most major markets over a relatively short period. That elevated base does not reset simply because growth has eased. It persists. It becomes the new normal from which all subsequent decisions are made. What this creates is a housing system that functions less like a market people can enter and exit fluidly, and more like a structure that determines financial position from the start. Entry into homeownership now requires a larger income commitment from the first payment forward. Renting at current levels absorbs income without building equity. Both paths begin from a higher cost baseline, and that baseline conditions everything that follows. When a larger share of income is committed to housing before anything else is considered, the remaining income has to work harder. Every other cost is now operating within a compressed space, and that is where the interaction effects become important. Healthcare in the United States does not typically arrive as a sudden financial event for most working households. It arrives as a deduction, quiet, recurring, already subtracted before the paycheck is even received. According to data from the Kaiser Family Foundation, the average annual premium for employer-sponsored individual coverage now exceeds $9,000. Family coverage approaches $27,000. Employers cover a significant portion of that cost, but employees still carry a meaningful share. And the premium is only one part of the structure. The average deductible for single coverage is close to $1,800. That means insured individuals often pay out of pocket for routine care before coverage meaningfully engages. The result is that healthcare functions not as a backstop for rare emergencies, but as a persistent fixed cost embedded in the household budget. It is not something most people can reduce without accepting increased risk. Those who choose lower-tier plans to manage the premium often find the deductible exposure rises accordingly. The cost does not disappear. It shifts in form and timing. Month after month, this cost draws from available income. It does not spike. It does not create obvious moments of crisis. And it simply reduces the usable portion of earnings in a way that is easy to overlook because it has become so routine. When combined with housing costs, it forms the structural core of what most households must cover before any discretionary decision is made. And the space left over, after these two categories are addressed, is where all other costs now compete. Food prices have not returned to where they were several years ago. They have stabilized at a higher level. The Bureau of Labor Statistics shows that categories like food away from home continue to rise faster than overall inflation. Electricity costs have increased across many regions. Natural gas pricing has shown larger year-over-year movements in parts of the country. The internet access, mobile service, and basic transportation have all settled into cost ranges that most households treat as fixed, even if they are technically variable. The important distinction here is between the inflation rate and the price level. A lower inflation rate means prices are rising more slowly. It does not mean they have declined. Households are not operating in a lower-cost environment. They are operating in the same elevated environment that took shape over the past several years, with the rate of increase now slower, but the base still elevated. These essential categories share a structural quality. They cannot be meaningfully reduced without affecting how daily life functions. Food is not optional. Energy is not optional. Connectivity has become embedded in how most people work and manage their affairs. Even households that attempt to reduce spending in these areas find a floor below which cuts are not practically available. So what accumulates is a budget structure where housing takes the largest share, healthcare removes another consistent portion, and the remaining income faces essential costs that resist compression. The flexibility that used to exist between income and obligations has been narrowing across all three categories simultaneously. And it is that combination, not any single cost, that defines the current pressure. When income is largely allocated to fixed and semi-fixed obligations, the system does not simply stop. It adjusts. The adjustment moves from the spending side to the balance sheet. Household debt in the United States has reached approximately $18.8 trillion, according to the Federal Reserve Bank of New York. Credit card balances have risen above $1.2 trillion. Auto loan balances and student loan balances are both tracking near $1.6 trillion each. These figures on their own are not surprising given the scale of the economy. What is worth examining is the function debt is serving. Borrowing that supports long-term investment follows a particular logic. A mortgage builds equity over time. education financing is expected to improve earning capacity. Business debt can generate returns that justify the obligation. These are decisions oriented toward an improved future financial position. They carry risk, but also carry the expectation of gain. A different pattern is emerging alongside that traditional borrowing. Debt being used not to reach toward something new, but to cover gaps in the present. A utility bill that arrives before the next paycheck. And a car repair that cannot be deferred. An unexpected medical cost that falls within the deductible. These are not investment decisions. They are maintenance decisions. They use future income to sustain current stability without necessarily improving the underlying position. Around 4 to 5% of outstanding household debt is currently showing some stage of delinquency. That figure does not suggest a systemic breakdown, but it reflects a portion of households where the margin has already closed, where income is no longer sufficient to service obligations without delay or difficulty. The broader pattern is that more households are relying on credit not to grow, but to hold. That shift changes the risk profile of the overall system. And it means the economy is functioning in part on borrowed capacity, and that borrowed capacity reduces resilience over time. The labor market remains relatively stable by most conventional measures. Unemployment near 4.4% represents a historically moderate level. Job openings still exist across many sectors, even as the pace of hiring has slowed from earlier peaks. But labor market stability and labor market flexibility are not the same thing. In the current environment, the ease of movement that characterized the labor market a few years ago has diminished. Transitions between roles take longer. White-collar sectors in particular have seen increased competition for a reduced set of openings. Certain industries that were actively recruiting have pulled back. The job market still functions, but it functions with less dynamism than it recently did. This affects household decision-making in ways that are not fully captured in employment statistics. Workers who might previously have taken a career risk, or negotiated more aggressively, or relocated toward better opportunity are now less inclined to do so. Not because opportunity has vanished entirely, but because the cost of a misstep has increased. When fixed obligations are high and savings buffers are thin, a period without income becomes a more serious disruption than it would be in a more flexible financial position. The effect is a quieter workforce, people staying in roles they might have left, avoiding transitions that carry uncertainty, accepting conditions rather than challenging them. Yet this matters because labor mobility is one of the mechanisms through which the economy rebalances. When people can move toward better wages or lower-cost regions, they improve their own position and relieve pressure elsewhere in the system. When that movement slows, those corrections become harder to make and imbalances persist longer. None of these patterns are distributed evenly. The national averages provide a framework, but the actual experience of financial pressure varies significantly by geography. Property taxes are one example. The Tax Foundation notes that they represent a major source of state and local revenue, but the rate at which they are assessed and the frequency of reassessment differs substantially by county and state. It's for homeowners in regions where reassessments happen frequently and valuations have risen sharply. The annual tax burden has increased in ways that are difficult to anticipate and hard to offset. Insurance costs follow a similar pattern. Premiums are determined by regional risk exposure, which has shifted in many parts of the country. Two households with similar incomes and similar homes can face very different insurance costs depending entirely on their location. In some coastal and southern markets, premium increases have been significant enough to materially alter the monthly cost of homeownership. Utilities and local service fees add another layer of regional variation. Electricity pricing, water costs, and municipal fees are set locally, and they compound over time. They are recurring. They are not easily negotiated. And in some regions, they have risen considerably. What this creates is a landscape of localized pressure zones where the interaction of housing costs, property taxes, Insurance and essential services produces cost structures that are substantially above the national average. Major metropolitan areas concentrate this dynamic. The opportunity that draws people to cities has always coexisted with elevated cost. But the current gap between what those cities cost and what typical incomes provide has widened in ways that are not easily closed. Miami carries the combined weight of housing appreciation and insurance premium increases that have moved significantly higher as regional risk is repriced. Chicago homeowners and renters alike have felt the effect of property tax pressures that translate directly into monthly costs. California's coastal markets maintain price-to-income ratios that place ownership beyond reach for most earners at or near the median. New York's entry costs extend beyond rent into deposits fees and recurring expenses that raise the total threshold for basic urban living. These are different situations with different causes, but they share a structural quality. Multiple cost categories are rising in the same direction at the same time, and the income available in those markets is not closing the gap. The picture that emerges from these layers is not one of dramatic failure. The systems are still functioning. People are working. Bills are being paid. The labor market is holding. The housing market has not unwound. Inflation has moderated. By the measures that appear in headlines, the economy is navigating reasonably well. Yet what has changed is something harder to quantify. The operating margin available to a wide range of middle-class households has narrowed. Housing absorbs more income from the start. Healthcare removes a consistent portion before discretionary decisions begin. Essential costs have settled at elevated levels that do not yield easily, and debt is increasingly being used not to build towards something, but to maintain what is already there. Consumer Financial Protection Bureau data reflects this quietly. Fewer households can cover even a single month of expenses without income continuing to flow. More report difficulty keeping pace with regular obligations despite being fully employed. The constraint is not unemployment. It is the relationship between what income provides and what the current cost structure requires. The shift in how people plan is perhaps the most telling indicator. Long-term financial goals have not disappeared, but they have become harder to hold. Retirement timelines lengthen. Major life decisions get deferred. Risk tolerance declines. Planning horizons compress from years to months. Not because ambition has faded, but because the present requires more management and leaves less room to look further ahead. This is the quiet transformation that is difficult to see in any single data point. It is visible only in the accumulation of effects, in how the layers interact, in what the combination of housing and healthcare and essential costs and debt and reduced mobility produces when they operate together on the same household budget over an extended period. The American economy has always carried within it a kind of promise, and not a guarantee of outcome, but a structural premise. That stability earned through consistent work and reasonable planning would hold, that a household operating within its means in a median income range could maintain security and move modestly forward over time. That premise has not been formally abandoned. It is still the framework within which most people conduct their financial lives, but the conditions supporting it have shifted beneath the surface. The cost of maintaining stability has risen. The margin available for error or adjustment has narrowed. The flexibility that allowed households to absorb change without fundamental disruption is thinner than it used to be. This is not collapse in the way that term is usually understood. There is no moment of rupture. There is no single cause or obvious failure point. What there is instead is a system that has gradually extracted flexibility from the households that were once best positioned to absorb it. The middle of the income distribution, the full-time workers, the homeowners and aspiring homeowners, The people who did the expected things and are now finding that the expected outcomes require more and more just to remain in reach. The numbers that describe the economy can be accurate and still miss this. Averages obscure distributions. Growth rates do not capture levels. Employment figures do not measure security. And a headline that says the economy is stable does not address whether the households inside it are gaining ground or quietly holding on. What this moment asks of anyone trying to understand it is a different kind of attention, not to the peaks or the catastrophes, but to the gradual, yet the persistent, the accumulating, the quiet narrowing of what used to be a wider margin. That narrowing is where the real story of this economy is unfolding right now, not loudly, not dramatically, but steadily and in ways that will continue to shape how millions of households plan, think, and live in the years ahead.